One line on one chart has come before every U.S. recession since 1980. 6 recessions. 6 warnings. Bank crises, oil shocks, a dot-com bust. It flagged them all, usually more than a year in advance. Then in July 2022, it flashed again. Louder and longer than ever before. And the recession never came. So what is the yield curve, really? The best recession signal we have, or a myth that finally broke? Today, we put it on trial. Every trial starts with a precise accusation. Here's ours. First, the basics. The U.S. Treasury borrows money for different lengths of time. 3 months, 2 years, 10 years, 30 years. Normally, the longer you lend, the higher the yield you demand, because more can go wrong over 10 years than over 3 months. Plot those yields from short to long, and you get an upward sloping line. That's the yield curve. But sometimes the line flips. Short-term yields climb above long-term yields. That's called an inversion. And the claim on trial today says this: when the 2-year Treasury yield rises above the 10-year yield, a U.S. recession follows, usually within about 2 years. This isn't internet folklore. In 1986, a young economist named Campbell Harvey documented the effect in his dissertation at the University of Chicago. The New York Fed later built a recession probability model on the same idea, using the 3-month versus 10-year spread. So the claim comes with academic credentials. Now let's test it against the tape. Before the evidence, the logic. Why would one line predict anything? The 10-year yield mostly reflects where investors think short-term rates will average over the next decade. If they expect the central bank to cut rates hard, long yields sink below today's short rates. And central banks cut hard for one main reason: trouble. So an inverted curve is really a message from the bond market. It says, rates are high today, but we don't believe they'll stay there. Something is going to break. Economists have tested this logic hard. A 1996 study at the New York Fed found the curve outperformed nearly every rival indicator at horizons of about a year, including the stock market and the professionals' own forecasts. That's rare in economics, and it's why this humble spread earned its reputation. There's a second channel, and it's more physical. Banks borrow short and lend long. That gap is their profit margin. When short rates sit above long rates, the margin gets squeezed, lending standards tighten, and credit slowly dries up. Which means inversion isn't just a forecast of a slowdown. It can help cause one. That's the theory. Now, the evidence, case by case. Case 1. August 1978. Inflation is running hot and the curve inverts. 17 months later, in January 1980, recession. Case 2. The curve inverts again in late 1980, while Paul Volcker's Fed pushes overnight rates toward 20%. Recession arrives in July 1981. 2 for 2. Case 3. December 1988, the curve flips once more. About 18 months later, in July 1990, the economy rolls over. Case 4. February 2000, almost the exact month the Nasdaq peaks, the curve inverts. Recession begins in March 2001, roughly 13 months later. Case 5 is the famous one. Around the start of 2006, the curve inverts and then stays flat or inverted deep into 2007. Most officials shrugged. The consensus said this time was different, that global savings had distorted the signal. The Great Recession began in December 2007, about 2 years after that first inversion, and became the worst downturn since the 1930s. Case 6. August 2019, the curve briefly inverts. 6 months later, the economy fell into the sharpest contraction in modern history. Add it up. 6 inversions since 1980, 6 recessions. The lags ranged from about 6 months to about 2 years, with the average near 14 months. That looks like a perfect record. It isn't. Time to cross-examine the witness. Exhibit 1, 1966. The curve inverted, forecasters braced, and no recession arrived until December 1969. 3 years later. Most researchers score that one as a false alarm. Exhibit 2, 1998. During the LTCM hedge fund crisis, parts of the curve flickered upside down for a few weeks. No recession followed for almost 3 years. Another blemish. Exhibit 3, 2019 itself. Yes, a recession followed within 6 months. But it was triggered by a global pandemic, something no bond trader saw coming. Would that inversion have been proven right on its own? We can't know. Manufacturing was already slowing in late 2019, so defenders count the case. Skeptics call it the luckiest call in market history. And there's a deeper problem. 6 clean cases is a tiny sample. In most fields, 6 data points wouldn't get you published. The record is striking, but it's suggestive, not proof. There's a paradox lurking here too. The more famous the signal becomes, the more it can diffuse itself. If an inversion scares companies into caution and nudges the central bank to cut rates earlier, the recession it predicted may never arrive. A warning that everyone watches can quietly cancel its own forecast. Which brings us to the strangest episode yet. In July 2022, with inflation at a 40-year high and the Fed hiking aggressively, the 210 curve inverted. It went deeper than at any point since 1981, more than a full percentage point upside down by July 2023. And it stayed inverted for roughly 26 months, the longest stretch on record, before finally flipping back around September 2024. The recession calls came instantly. In late 2022, mainstream surveys put the odds of a U.S. recession within a year at roughly 2 in 3. Yet, as of early 2026, no U.S. recession had been declared. Unemployment stayed historically low. Inflation came down anyway. The landing, so far, looked soft. What happened? 3 honest possibilities. First, the signal was distorted. Years of quantitative easing compressed long-term yields, which makes inversion easier to trigger and less meaningful. Second, this cycle was genuinely unusual. The Fed was fighting inflation in an economy still cushioned by pandemic savings and heavy government spending, so tight policy didn't bite the way it used to. Third, maybe the believers just had the timing wrong, and the verdict needed more patience. Here's the remarkable part. Even Campbell Harvey, the researcher who first documented the signal, publicly wondered in 2023 whether his own indicator was flashing a false positive this time. When the discoverer doubts the discovery, you should at least entertain the doubt. So, recession signal or broken myth? Here's the nuanced verdict. Guilty of being useful. Not guilty of being a law of nature. From 1978 to 2020, the inverted yield curve was arguably the best macro warning light available anywhere. It's public, it's free, and it fires early. But the 2022 episode exposed the weakness. The curve reads market expectations, and expectations can be wrong, distorted by policy, or overtaken by events nobody priced. That's why careful researchers never read it alone. They pair it with credit spreads, jobless claims, and bank lending surveys, and then watch whether the real economy confirms the warning. One instrument is a clue. A full dashboard is a case. The honest way to treat the yield curve is as a barometer, not a countdown clock. When it inverts, the bond market is telling you that policy is tight and cuts are expected. That is valuable information about where we sit in the cycle. It is not a date on a calendar. Myths break when people treat probabilities as certainties. Signals survive when you respect their limits. Quick recap. The yield curve inverts when 2-year yields rise above 10-year yields. Since 1980, that came before all 6 U.S. recessions, with lags of 6 to 24 months. But 1966 and 1998 were false alarms, and the record-breaking 2022 inversion passed with no declared recession as of early 2026. The verdict, a powerful barometer with a cracked lens. Worth watching. Never worth worshipping. If you want to understand the next cycle before it arrives, that's exactly what this channel exists for. Subscribe, because in this series we're decoding the machinery behind booms and busts, one signal at a time. Next up, we take on the housing market and an 18-year pattern hiding in plain sight. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.